Greetings in the new year and welcome to our 2026 Outlook webinar. We hope you find it interesting and informative. I'm Steve Hawarda, our firm's managing director, and we appreciate you joining us. Last year, we expected the capital markets to reward investors, but they were even better than we hoped. But for our company, the most significant milestone of 2025 was on December 1st when we celebrated our 50th anniversary. So we're going to show you a video, 50 years, in 3.5 minutes. We hope you enjoy.
Ferguson Wellman Capital Management presents a succinct history of our firm.
The year was 1974. Rubik had just dropped his new cube. Ali was prepping to rumble in the jungle. Women had finally received the right to hold a credit card. And President Gerald Ford signed into law ERISA, ushering in new standards for managing pension plans. Fast forward to 1975. Across the country, in the city of Portland, Oregon, our three founders, Norb, Joe, and Monty, set out to launch a new kind of investment firm, built to help manage those pension plans and support families in need of investment advice. Things started out slowly, but one client turned to two, and two to four, and, well, you get the picture. Before they knew it, they weren't just serving Portland. New clients liked the idea of hiring a team, not just an individual. And in 1981, Joe and Norb decided to offer a chance for ownership beyond the founding partners, because you tend to treat your own car better than a rental. Along the way, there were ups, and there were downs. But through it all, the firm always found a way to weather the storm and stay the course. That brings us to our 50th birthday. Pluto is no longer a planet. Disco is dead, and the mustache is back in vogue. A lot has changed since 1975, but the fundamentals remain the same.
To succinctly describe Ferguson Wellman's success, the key to that success has been the people, period.
I think our firm has done a really good job hiring over the years.
Today, our employee-owned firm manages over $10 billion in assets for more than 1,000 clients, including over 60 nonprofits. We still come into the office 5 days a week. We still wear suits, and we still pick individual stocks and bonds to ensure the success of our clients. Sure, we're money managers, but we're also ducks, beavers, huskies, and zags, mothers and cat moms, fathers, athletes, and even actors. You can find us out in the community serving on boards, serving up financial education, or serving heat out on the court. We've come a long way since 1975, and it's safe to say that these guys, they'd be proud. So, as the firm looks toward the future and this video comes to an end, there's just one thing that we'd like to say to everyone who has trusted our team along the way.
Thank you!
On behalf of Norb Wellman, Monty Johnson, and Joe Ferguson, we thank you all for being part of this program and, more importantly, part of our firm.
Hey, it's fun and rewarding to look back over the last 50 years, but more importantly, looking ahead to the next 50. How do we exceed our clients' expectations for service, performance, and advice going forward? The single most significant ingredient to this recipe hasn't changed. It's people. Hire the best, set high expectations, let them own a piece of the company to align their interests with yours and empower them to fulfill their potential. In our presentation today, you will see an example of our talented people. Our four speakers represent 3 generations of ownership. Structuring our firm with layers of experience and ownership is an intentional strategy we have implemented over the last 20 years to ensure continuity and consistency for our clients over future decades. Each speaker is a significant shareholder, portfolio manager, and leader in our firm. Mary Lago, principal owner and our chief wealth strategist, will kick us off with wealth management. Joining her will be Sammy Paulo, executive vice president and the chair of our wealth management committee. Then two of our investment team, George Hosfield, Principal and Director, and our Chief Investment Officer, will be joined by Brad Hool, Principal and a member of our Investment Policy Committee. Thanks again for joining us, and we wish you a fabulous 2026.
Thank you, Steve. As we manage investment portfolios and build wealth plans for our clients, our strategies and recommendations are shaped by tax policy. We remain focused on enhancing our clients' after-tax returns and collaborating with tax and other professionals to support client goals such as retirement planning, education funding, and charitable giving. Now, some of you have heard that there was a new tax act last year, and today we're going to highlight a few aspects of the 2025 Tax Act, sometimes referred to as the One Big Beautiful Bill, and how it impacts planning decisions.
Before diving into what's new, it's worth taking a step back and recognizing that from a big picture planning standpoint, the most impactful part of the new tax rules are really what didn't change. The favorable tax brackets and rates were retained, the higher standard deduction remains in place, and the elevated federal estate tax exemption was preserved at $15 million plus inflation adjustments. From a dollar impact perspective, these retained provisions are where people are likely to see the greatest tax savings by avoiding the tax increase that would have occurred had the rules not been extended. That said, there are a few provisions that are new and worth noting. Today, we're going to focus on 3 areas that have generated the most client questions: income-linked deductions and phase-outs, expanded education funding options with 529 plans, and some new charitable giving rules.
The Act introduces some new tax deductions that are limited based on income levels. That's not really a new concept. Historical examples include medical expenses, tax-deductible IRA contributions, and higher income earners are also limited in their ability to contribute to Roth IRAs, and their Medicare premiums are higher. But the new deductions that are subject to income limitations include a general cap of the value of the itemized deductions at 35%. In other words, those in the 37% bracket will only reduce their income tax liability by 35% for deductions. Now, these deductions include things like charitable giving and mortgage interest and any other itemized deductions. There are also income limitations to be eligible for the highly anticipated expanded SALT deduction. More on that in a moment, as well as the new tip and overtime income deductions. Finally, seniors who don't exceed $75,000 of income per person are also eligible for a new but temporary higher standard deduction. Because the expanded SALT deduction has garnered so much interest, let's take a closer look. For those of you who are not familiar, the SALT deduction refers to the amount of state and local income taxes that can be deducted on your federal income tax return. Now, once upon a time, the full amount that you paid in state income taxes, property taxes, and select other local taxes were fully deductible on your federal return. But the Tax Cuts and Jobs Act limited this deduction to $10,000. Under the new rules, the SALT deduction can be as high as $40,400, but it phases out once your adjusted gross income exceeds $505,000, and it drops back to that $10,000 for those with income in excess of $606,000. So, the minimum SALT deduction available is $10,000, and the maximum available SALT deduction is $40,400. People get a little worked up about that, but the tax savings between the minimum available SALT deduction and the maximum is approximately $10,000. So this means that while limiting income to $505,000 or less may be useful, the tax savings is small enough that it may not be the deciding factor in strategies that accelerate income, such as Roth IRA conversions. In light of these new income-limited deductions, you may want to coordinate more closely with your CPA in case you're on the cusp of qualifying, but the potential savings is likely small enough that it won't drive your financial strategies.
Another major consideration for many of our clients is charitable giving, often tied to their personal values and legacy goals. Now, while people give to charity for a variety of reasons, many do want to maximize the tax efficiency of their charitable giving so that their donations will have the greatest possible impact. The 2025 Tax Act introduced a few changes that are worth noting. First, for itemizers, there's now a 0.5% of adjusted gross income floor before charitable donations become deductible. Also, the tax benefit of donations are limited for taxpayers who land in the highest tax bracket. On the other hand, the good news is that the 60% of income limit on charitable donations of cash was extended rather than dropping back to 50% as it had been in the past. Now, before moving on, I want to pause on that 0.5% floor. This rule's received a lot of attention, but in dollar terms, it's really not that material. For example, someone who's earning $100,000 and makes a $10,000 donation would find that $500 was not deductible, leaving a $9,500 deduction. So while it's annoying, it doesn't likely move the needle for planning purposes. Moving on to those who don't itemize, but rather take the standard deduction, there's a new $1,000 deduction for cash gifts to operating charities, and that can be doubled for married couples. So that's in addition to the standard deduction. Now, even with these changes, many of the long-standing charitable giving strategies that we use remain effective. For example, the qualified charitable distribution from your IRA, or it's called a QCD, and donations of appreciated property. For individuals who are over age 70 and a half, a qualified charitable distribution from an IRA, that QCD, allows you to donate directly from your IRA to charity, count it towards your required minimum distribution for the year, and exclude it from taxable income. On the other hand, now more people may be itemizing due to that higher state and local tax deduction. We may see increased donations of appreciated securities. In that case, you receive a deduction for the full fair market value of the donated securities, you avoid paying capital gains on the appreciation, and you're effectively supercharging the tax benefit of that donation. Now, the right strategy for any one person or family really depends on the mix of their income, their deductions, and their charitable goals. For clients who are planning large charitable donations, it can be very helpful to evaluate your circumstances with your tax advisor and portfolio manager in order to identify what strategy is likely to produce the greatest tax savings while achieving your charitable goals.
Families with wealth often worry about the impact of that wealth on future generations. We hear phrases like, I want my children to be productive members of society, to be able to taste and savor their own successes. Warren Buffett summed it up well when he said, I want my children to have enough that they can do anything, but not so much that they can do nothing. Families with more limited resources often see education as a pathway for greater success. So, with this backdrop, it's not surprising that education funding is a high priority for many families. 529 plans have long been one of our favorite education savings tools because they offer tax-free growth and tax-free withdrawals so long as the funds are used for qualified education expenses. The 2025 Act made them even more versatile with the expanded ability to use funds for primary and secondary education and graduate school. Well, before we delve into the details, remember, these can be funded with the annual exclusion gift amount of $19,000 or superfunded with $95,000 from each person making a gift to each person receiving the gift without using any of your lifetime gift tax exemption. Now for the specifics. The 2025 Tax Act increased the amount that can be used for kindergarten through high school to $20,000 per year from the previous $10,000 limit. Funds can also now be used for credentialing and licensing programs such as the bar exam and the Certified Financial Planner program that many of us here have participated in. And the funds can be used for purposes beyond tuition, room, and board. It also now includes books, standardized test fees, online education, and tutoring. But not all states conform to this federal tax policy, so you may have some state income taxes to pay when funds are used for these purposes.
In conclusion, our role is to help our clients stay focused on their long-term goals while coordinating closely with their tax and legal advisors to make sure that the planning strategies we're using remain aligned and tax-aware. Tax laws are always going to change, but when you have a strong plan rooted in your goals, those tax changes become something we help you navigate, not something that derails your plan. With that, we'll turn it over to our investment team for our 2026 investment outlook.
Thank you, Sammy. Thank you, Mary. And thank you for joining us for our Outlook 2026. As is our tradition, in the interest of transparency and full disclosure, before we look ahead, we first take a look back at what we said last year. To that end, the title of our Outlook last year was Lessons Learned. It was our 50th anniversary of the firm that we were celebrating, and we thought we would frame our outlook in the form of enduring, sort of time-tested lessons related to investing that applied last year. Number one, psychology. We said turn down the volume. In other words, remove emotion and focus on the data. That was really important in a year with a new administration and a lot of concerns about unprecedented tariff levels. We indicated that we thought the fears were overblown, and of course, that turned out to be true. Second, with regard to the economy, as the consumer goes, so goes the economy. And we said, don't bet against the U.S. consumer. There was concern that the consumer was tapped out. Same thing this year. We said the consumer was in good shape. And of course, the consumer spending was up 4% and the economy was great last year. In terms of capital markets, we said history doesn't repeat itself, it rhymes. And that was related to a contrast between the Nifty 50 back in the 70s and the AI leadership that we've experienced in recent years. And bottom line is we said that the AI was going to continue to be an important part of leading this market ahead and not abandon those stocks in 2025, which of course turned out to be very profitable and was the right call with respect to portfolios. And finally, with regard to asset allocation, sometimes the hardest thing to do is nothing. There's a lot of feeling that at the beginning of a year that you need to realign things in a portfolio. We thought that we were appropriately allocated with an overemphasis on large cap stocks, underweight small cap and international. And we give ourselves partial credit there because certainly equities were the place to be, but we were wrong with regard to international. That was the best place to be with regard to equities, something that we don't think will be repeated in the year ahead. Turning our attention to this year, we'd like to play a short video to introduce and set up our theme for 2026.
There are increasing fears that the U.S. consumer is tapped out, that the Federal Reserve was too late to start easing interest rates, that AI is a bubble that is about to burst, like the dot-com bubble of 2000, and that the stock market is woefully overvalued. Team Ferguson, your mission, should you decide to accept it, is to deliver a fourth consecutive year of positive returns. As always, should you or any of your Ferguson Wellman team members be caught or killed, the Secretary will disavow any knowledge of your actions. This tape will now self-destruct.
So our mission is to deliver a fourth consecutive year of positive returns. Skeptics would say that the consumer's tapped out, that the Fed has been too late to cut rates, that AI is a bubble about to burst, and that the market is so overvalued it's about to sell off. Those four things they believe collectively would make this a mission impossible. But is it? Let's take a look at the first obstacle, the consumer. As the consumer goes, so goes the economy. And right now the consumer's not happy, and inflation is the number one concern among consumers around the nation. If you take a look at CPI growing at less than 3% now, you would think inflation is tame. But the reality is the cumulative effects of inflation over the years has been really significant, particularly on the sort of common man. What we have here is something that our colleague Jason Norris put together called the Breakfast Index. And it's an attempt to try to figure out what the impact of inflation is on the average person on the street. It's a calculation of the inflation of a breakfast, orange juice, coffee, bacon, eggs, and you can see from 2019 that breakfast has gone from $8 to almost double at $15. This sort of level of inflation, it hits everybody, but it's particularly painful for people at the lower income levels, to be sure. So if you look at consumer confidence here as measured by the University of Michigan Consumer Sentiment Index, you see that right now consumer sentiment is at an all-time low, lower than COVID, lower than the great financial crisis. It is amazing that at a time that unemployment is only 4.4% and the market is at an all-time high, that the consumer is this unhappy. Because at these levels of dissatisfaction, it historically translates into very low consumer spending and therefore recession. But the important thing to do is not focus on what consumers say, but what consumers do. If you contrast this very pessimistic consumer sentiment level here in red with retail sales, you see that consumers continue and have continued in recent years to spend. So two things are important with consumers. Are they willing to spend? And the answer is yes, as you can clearly see. Though they're very pessimistic, they continue to spend. The second important thing is, do they have the capacity to spend? A lot has been made of the fact that consumer debt is at all-time highs, which is true, it is. But you need a little more context because right now consumer income is also at an all-time high. As such, what we really need to do is understand what is their capacity to spend within. If you take a look at non-mortgage debt service, in other words, how much does it cost to service student loan, auto loans, consumer credit card loans, all of those sort of interest expenses, for every dollar of income, right now the average consumer spends 6 cents on debt service, something that is lower than we saw in 2019. It's up from the lows of 2021, but the fact is the consumer not only has a willingness to spend right now, but the capacity to spend. And finally, as we look to this year, thanks to the new tax act that was recently passed, there's going to be an additional $185 billion of stimulus introduced into the economy. Now, that sounds like a big number, sort of distances in space that you can't relate to, but 185 billion would translate to 0.5% of GDP. In other words, an economy that otherwise would grow at 2.5% would now grow at 3%. Or bringing this home, that means $1,000 for every household in America. That's a stimulus level that's equivalent with what we saw in COVID. So the consumer's employed, they have a willingness to spend, they have the capacity to spend, and there's additional stimulus on the way. So our view is, if our mission is not to be accomplished in 2026, it will not be because the consumer didn't follow through. At this time, I'd like to turn the floor over to my colleague, Agent Houle, to take on the next obstacle.
Thank you, Agent Hosfield. This brings us to our next obstacle to completion of the mission, that rate cuts have been too late. There's been a lot of criticism that the Federal Reserve was slow to cut rates as the labor market softened. The Fed doesn't get to focus on just one thing. It has to balance jobs and inflation. With tariffs threatening to push inflation higher, the Fed chose to move cautiously. In our view, that caution was intentional and appropriate. A year ago in our outlook, we said we'd take the under on tariffs. So far, largely, that's been the right call. Inflation has stayed around 3%, roughly where it was before the tariffs. Effective tariff rates have settled closer to 10%, well below the initially threatened 25%. And despite all the noise, economic growth in 2025 has remained close to 3%. So while tariffs are inflationary in theory, in practice, the impact on the economy has been smaller than feared. However, tariffs weren't cost-free. The uncertainty surrounding tariffs clearly impacted the labor market. Job growth slowed meaningfully over the course of the year. We started 2025 creating around 200,000 jobs per month. By December, that number had fallen to 0. The key question is why the labor market softened. It is our belief that companies slowed hiring due to uncertainty around tariff policy. When policy is unclear, companies don't fire first. They pause hiring. They wait for clarity, and that's exactly what we've seen. While very few jobs are being created, there also hasn't been a surge in layoffs. This is a graph of weekly initial jobless claims. This data is almost a real-time measure of layoffs in the economy. The number remains well below the long-term average. Hiring slowdowns can reverse quickly once uncertainty clears. Layoff cycles are much harder to stop. So how does the Fed think about this? Through its dual mandate. Think of it like a teeter-totter. Inflation on one side, employment on the other. Right now, inflation is still above where the Fed wants it, and employment isn't collapsing. So that's why we believe the Fed can ease gradually rather than needing to sprint. Our expectation remains for 2 quarter-point rate cuts, measured, not rushed. It is our view that rate cuts were not too late. Trade policy is becoming clear. Businesses adapted. Job losses are not elevated, and while inflation is still above the Fed's ideal target, it remains well below the long-term average. Patience by the Fed wasn't a policy error, it was a prerequisite for stability. Now let's shift to our next obstacle to completing the mission. Artificial intelligence is a bubble. With all the headlines comparing AI to the internet bubble of the 2000s, it's easy to think we've seen this movie before. Big stock price performance, massive capital spending, plenty of hype. One of the largest fears around AI is disruption in the labor market, but history tells a different story. Change is constant in the labor market. This chart shows unemployment going back to 1948. The takeaway for the chart is that unemployment is driven by business cycles, not technological advancement. In fact, about 60% of U.S. workers today are in occupations that didn't exist in 1940. Technology has always displaced tasks, not the work itself. This brings us to the real promise of AI. We believe AI will ultimately bring higher living standards. Every major technological shift from mechanized farming to the printing press has raised living standards over time. The primary engine for increasing living standards is through gains in productivity. What this means is you get more output for the same labor and capital. Productivity gains are the holy grail of economics. For example, when Microsoft Excel arrived in the early 1980s, companies didn't fire all their bookkeepers day one. Bookkeepers stopped using green ledger paper and started using spreadsheets. The job didn't disappear, it became more efficient. Over time, bookkeepers were needed. However, new roles such as analysts and consultants, more highly compensated knowledge workers, those roles grew. These transitions don't happen overnight. They're gradual, uneven, and measured in decades, not quarters. Now let's rewind to the dot-com era and see what a real bubble looks like.
Deliveries for pets.com, purely in an advisory role. I like your shorts. You're a good looking fella. I hope they're home. Oh, wow, you cats hit the jackpot. There's enough food here to feed a lion. What goes up? Try to get it. Try to get it. Try to get the burger. Must come down.
Pets.com. This was the most notorious company from the dot-com era. The business was a poster child of speculation and excess. What you just saw was a Super Bowl ad that cost $1.2 million to run one time. At that point, the annual revenue of Pets.com was just $5.8 million. The company spent 20% of its annual revenues on one ad. Pets.com had an initial public offering in February of the year 2000, the peak of the dot-com era, and the company was bankrupt by November of 2000. The sock puppet was sold in 2002 for $125,000. This was the residual value of the business. This is what a bubble looks like. We believe that the current AI cycle is not dot-com 2.0. From 1997 to 1999, technology stock prices rose more than 300%. All the while, earnings grew just 62%. A bubble is when stock prices race ahead of earnings. Since 2023, AI-related stocks are up about 124%, but earnings are up more than 200%. In this cycle, profits are leading prices, not the other way around. This is an important distinction and puts the technology cycle on firmer footing than the dot-com era. We believe that AI investment has room to run. Historically, major infrastructure cycles like railroads and electrification build-out absorbed 4 to 6% of our entire national income or GDP at their peak. The AI infrastructure build-out today is only 2% of our GDP. We believe this AI build-out has room to run. Unlike prior cycles, this capital cycle is being funded primarily by cash flows, not leverage. That makes it structurally more durable. AI is no longer confined to a handful of technology companies. It is a broadening investment opportunity. Data centers are becoming the factories of the digital age. Everything that goes into data centers is becoming part of the AI economy. For example, industrial companies that make HVAC equipment and power infrastructure are now benefiting from the increased demand due to the build-out of data centers. In addition, due to the massive consumption of electricity by AI, utility companies have gone from boring to essential part of portfolios. We don't believe that AI is a bubble. AI adoption is a long-term cycle. It will take decades, not quarters. AI is not expected to drive unemployment dramatically higher. AI share of the economy is not extreme, and profit growth, not hype, has driven stock prices. This doesn't mean it's risk-free, but we do not think that artificial intelligence is a bubble. With that, I'll hand it back to Agent Hosfield to confront the next obstacle to completing the mission.
Thank you, Agent Houle. And to our last obstacle, the stock market. Is it overvalued? Well, clearly, if you take a look here at the S&P in recent years, it's been a great run. Over the last 3 years, the market's up 80%. It's really, quite frankly, almost been parabolic. But we like to say every year that this is a simple business. If you tell us where earnings are going to go, we'll tell you where the market's going. And over the long term, that's been very evident here. When you overlay earnings to the level of the S&P, you can see the correlation is quite tight. If you look at the upper right here, there's a red circle indicating the last 3 years, and you'll note that all of the appreciation in the market has been driven by earnings growth. In other words, the market has earned this level where we're trading at today. Now, where we're trading today is a price earnings ratio of 22 times earnings. By historic measures, that's not cheap. An average sort of PE multiple over the long term for the S&P is 16 times. In other words, investors are willing to pay an average of 16 times what a company earns. Now, with an S&P trading at 22 times, you have to look at the constituency of it. In other words, the Magnificent Eight, those big AI leaders, they're trading at 32 times earnings, and they've justified that. They're growing earnings at 25%. The other 492 stocks in the S&P are trading at only 16 times earnings. And in fact, the non-AI stocks, if you look over the last 2 years of the earnings progression of the non-AI, earnings growth has gone from 6% to 9% growth last year to an estimated growth rate in earnings of the 492 of 11%. So the market is broadening out the leadership and what's driving it. So we don't believe that the current valuation is not sustainable or justified. Right now, the average expectation for the S&P earnings for 2026 is 14%. So is this market level sustainable? If earnings come through, yes, indeed it is. So again, we don't believe the market is too expensive at this point in time. It's fairly valued, particularly if earnings come through. So our belief is the consumer's not tapped out, that the Fed's not too late to cut rates, that AA is not a bubble that's about to burst like .com, and that the market's not overvalued. The level's justified at this point in time. But mind you, this is a high-risk mission. If we were to be unsuccessful at accomplishing any one of these, it could jeopardize the mission, to be sure. We understand the risk. As such, we want to point out that we have taken some measures at the end of last year to reduce risk modestly in portfolios. Here you see our asset allocation at the beginning of last year. The color coding, if you look at the top left, for equities, green means we're overweight, in other words, leaning into it, and red means we're underweight or leaning away from the asset class. So in other words, as we began last year, we were overweight large cap US stocks. We're emphasizing those and de-emphasizing small cap and international. We were neutral right in the middle of the allocation in bonds and underweight alternatives. And at the end of the fourth quarter last year, we took some risk out of the portfolio by reducing stocks. But the stocks that we reduced were large cap stocks, particularly AI related ones. We took some profit. In other words, took some risk out of the portfolio. So we reduced to neutral our weighting in stocks, but we're still overweight large cap, still underweight small cap and international. And bonds were now slightly overweight. This is the most conservative allocation we've had in about 10 years. So we're acknowledging the risk that the market is facing, but we still believe US large cap stocks will lead the way. Will 2026 prove to be a mission possible or a mission impossible? You'll have to tune into the sequel next year to find out. In the meantime, let's roll the credits and then we'll open up for questions. We're going to open up the floor for maybe 10 minutes of questions. As the chat indicated, if you want to submit a question, please click on the Q&A icon and submit it. It will be private. We'll be the only ones that will see it. Nobody else will see that you submitted the question or who the identity is. With that, I'd like to lead off with a question for Brad. One thing that we didn't cover was something that just happened, and that's the new nomination of a Fed chair in Kevin Warsh. Brad, what is our expectations for the market reaction and the change in the landscape with a new Fed chair next year?
Great question. With the nomination of Kevin Warsh, it shows that there is definitely an appreciation by the administration of wanting to have a Fed chair that is trusted. Kevin Warsh he's a known commodity. He was a Fed governor during the financial crisis and has a reputation for being able to bridge Washington and Wall Street. And so the confirmation hearings and all of that is to come, but thus far we've seen really no negative reaction in the markets from the nomination.
Thank you, Brad. Mary, you mentioned that what stays the same in the new Tax Act is actually more impactful than what's changing. Can you explain that a bit, please?
Yes, the major things that we saw in the 2025 Tax Act from a dollar perspective are the higher federal estate tax exemption and the higher income tax rates and some other things like standard deduction. So, to break that down just a little bit, the higher estate tax exemption, or the amount of money you can give away without paying a 40% federal gift or estate tax, is now at $15 million. If that had sunsetted back to the anticipated somewhere in the neighborhood of 7.2 million, that would have increased the estate tax liability for each person by about $3 million for those subject to estate tax, or about $6 million per couple. So huge impact from a dollar and cents perspective. Likewise, on the income tax side, we saw some pretty significant changes in terms of what stayed the same. And that is that the top federal income tax bracket remained at 37% rather than reverting back to the 39.6% that it was if we take a peek back to 2017. And to put a little context around it, also, you hit that top bracket in 2017 when someone who was married filing jointly had income that exceeded about 418,000, and this year that's 768,000 and change. So the income tax exposure for most individuals is significantly less. And then the standard deduction remaining higher, it's not quite, but it's nearly triple what it was back in 2017 at about 32,200 for married filing jointly couple. And that is particularly powerful for low income earners who may not have higher income taxes that they're paying, higher mortgage interest, or larger charitable deductions. So there's really something in it for everyone, but it's what stayed the same that's most impactful.
Thank you, Mary. Sammy, on a somewhat related note, does a higher federal estate exemption mean that we don't need to make large gifts to our kids?
Great question. No. So while the exemption is much larger, as Mary alluded to, there are still a lot of reasons that can be compelling to do those gifts now during life. First is to remove future appreciation. So while that exemption is subject to inflation increases, if your assets are growing beyond the rate of inflation, then over time that growth could expose you to federal estate tax or more federal estate tax, and shifting that to the next generation can be a great strategy from a tax standpoint. There's also state level estate taxes to contend with. So here in Oregon and up in Washington, they have much lower estate tax exemptions. So planning can be done, especially using gifting, to help reduce the state estate tax exposure. And finally, there's always the benefit of helping your children now. A lot of times folks are gifting at a time when their kids need access to assets in order to do things like build a business, buy a home, sort of set their life up. So there's just some goals and values benefit to doing that gifting that add to the tax savings. The one thing I will remind people is that we do have to think about the trade-off between something called a step-up in basis. So when you pass away owning assets, the unrealized gain is eliminated in a lot of kinds of assets, and gifting it during life, your heirs will take carryover basis. So there's some analysis to be done if you're thinking about doing large gifts to make sure that we're considering both the estate tax savings and future income tax issues.
Thank you, Sammy. Brad, can you explain the meaning of the K-shaped economy?
Yeah, certainly. And that really kind of dovetails with what we were showing with our breakfast index and consumer confidence. And essentially what that means is with a K-shaped economy, there's a different experience for different consumers. Wealthier consumers are, if you own a home and a stock portfolio, you feel relatively wealthy and you're spending. With the K-shaped, if someone's in a lower income demographic, they're more concerned about the price of eggs. And so you have a very divergent experience amongst consumers in different demographics.
Brad, thank you very much. I'll jump in this next one. What are our thoughts on precious metals? What a difference a week makes. Last week, we got everybody together and showed the last 20 years, given the parabolic move that we've seen in silver and similar move in gold. As of last Monday, over the last 20 years, gold, silver, and the S&P all had the same return. Well, Monday brought a 31% decline in silver and a 14% decline in gold, and it sort of answered our question because we don't own either of silver or gold. We owned gold one time between 2007 and 2009. Precious metals are a very volatile series. They tend to perform best when there's concerns about currency debasement. Last year, the dollar was under pressure. That helped fuel precious metal prices. Obviously, central banks are purchasing gold. We just don't believe this is something that is appropriate for our clients. If you look at gold over the past 50 years, there was a 20-year period was down 60%. I mean, anything that can be down 30% in a day just isn't suitable for our clientele, to be honest. Next question. Let's go to Mary. How much should we put into a 529 plan?
Good question. There's no magic number. When you think about, we get this question a fair amount, or what if I put too much in and concern? So first thing is, what is the age of the child? What kind of a university? Is it public, private, in-state, out-of-state? And our team can even do analysis based on specific schools where we help project these things out based on the age of the student, the expected cost, which is kind of tied to that school, and then what portion of the education do you want to cover? So we've run some generic analysis, and conveniently, if both spouses are maximizing that super funding, that $95,000 per person, that gives a really good base that when we look at for a minor or child being born today, that's likely to cover the full cost of their education by the time you inflate the education expenses and by the time you inflate the value or earn some returns on the investment that you're putting in. But you can really do some pretty specific analysis. Our team is happy to do it. We can turn that around pretty quickly. So feel free to reach out to us with any more details, and we'll be happy to follow up with you.
Thank you, Mary. Time for maybe two more. Brad, maybe we'll share this one. There's a question they'd love to hear more about our thought process behind being underweight international last year. I sort of danced around that a little bit. I'll tee this up, and that last year the dollar was weak. It was under pressure. The lack of predictability on the part of our government was something that caused people to lose confidence, and the dollar declined about 9%, which provided, conversely, a nice return for international investors. Also, after 12 years of underperformance, international stocks were cheap, and there was a rebound, and higher multiples were accorded. We got that wrong. Brad, would you add anything to that as to, obviously we're wrong, international turned out to be the best equity market category. Is there anything you'd like to add to that?
Yeah, we were wrong in terms of the absolute weighting, but instead of being international, we were in domestic large cap equities, which also did relatively well. And we have found that it's exceedingly difficult to get international right. It has a tendency to underperform for long periods of time. And then like last year, you'll have a spectacular year. So we're not adding to it this year. We're not going to chase it. And the volatility around the dollar remains very difficult to forecast.
Thank you, Brad. Sammy, is the 37% top tax rate truly permanent?
No. So there's a lot of commentary about the permanent changes that came through the Tax Act last year. And while the wording of the law does not include any kind of sunset date, which is with the 2017 rules, we were dealing with a sunset date, which is why it was such an area of discussion. The new rule doesn't have a sunset date, but it's important to keep in mind that future Congress can always pass new rules and change the rates, the brackets, the deductions, how taxable income is calculated. And with the national debt growing and some of the political wins, I think there's reason to believe that in the future there would be upward pressure on tax rates, especially for those in the higher income brackets. So the long and the short of it is we want to plan and utilize the brackets we have now. And usually we are planning with the rules that we know while also hedging against the kinds of changes that might come in the future because we don't have a crystal ball with respect to tax law.
Thank you, Sammy. To be respectful of people's time, this will be the last question. In the event that you submit some other questions or didn't have a chance to, please reach out to your portfolio manager or info@fergwell.com. I believe that's in the chat, and we'll be sure to answer those questions. Brad, the final question is this, and it's very timely given what the market's done the last couple of days. Question is, what is our view on private credit? And could we comment on the recent pressure on private credit due to the fear of AI and its impact on software as a service businesses?
Yes. So our view on private credit, we have been easing out of private credit for well over a year. And And our thought was that we were, closer to the end, the beginning of a credit cycle, and interest rates had gone up to the point where we didn't need it anymore. Recently, private credit has been in the news that a lot of software as a service companies their business models are in question due to the growth of AI. And so you're seeing this in many software companies that are just regular publicly traded, but you're really seeing it particularly in private credit companies that are publicly traded, that their stocks have gone down quite a bit, and we're seeing some distress in that area. It's not widespread yet. Mostly it is fear, but it has been disruptive in that market.
Thank you, Brad, Mary, Sammy. Thank you, all of you, for your time. It's been a privilege to be of service to you and your families. And on behalf of everybody at Ferguson Wellman, thank you. We wish you the best in 2026. And again, any follow-up questions, please send it to info@fergwell or your portfolio manager.